Good afternoon. I'm Lisa Lagerstrom with Washington Apex. Today we're kicking off our insurance and bonding session. This is our fourth session for the Advanced PortGen virtual training. The intended audience is for the contractor and supplier who has not yet worked with the port and want to learn more. So we have covered, just to give you an update, we have covered government contracting, we have covered business development, and prevailing wage. Today, we're going to do insurance and bonding. And next week, we're going to finish it up with financial considerations. So this 5-part series is to help that contractor and supplier understand how to do business with the port. So let's get started. First of all, let's talk about the session logistics. The presentation was sent to you last night, and the recording will be on the Port of Seattle site. And there's the link. We are going to ask you to put in chat your questions, and Kara's going to gather those at the end, and we will have time for Q&A. We're going to have a break between insurance because we're going to have Christina talk about insurance, and then we're going to have Kara talk about bonding. And I said Kara, her name's Kara. Sorry for that one. So Kara is your moderator, Kara is your bonder. And then we are asking that you do take 5 minutes to do the post survey. It helps us understand how we can do better and what worked for you. We always want to make sure that we are fulfilling the needs of you, the contractor and supplier, on what you need to be successful. So I'd like to introduce you to Christina Dorr with DeFranco Insurance. We're going to get started. Thanks.
Do you want me to start? Okay. And finding those solutions for clients is what leads me here today, because being a contractor is challenging. We have supply chain issues. We have unexpected things like COVID. So the least I can do today is try to help you understand what these insurance terms mean and why these are required in your contracts. Of course, there's many other items that I'd like to go over, but I'm trying to focus on what we're here to do today, which is to review the contract. So the objective that I have for the insurance portion is to provide you with those tools needed to understand the contractual insurance requirements. The problem is that most contractors are excited to bid the contracts and win that bid, but in doing so, many do this without considering the insurance requirements. This is problematic because oftentimes the insurance requirements cost more money, and that can affect your profitability of that particular job in a very negative way where you're losing money. So to work with the Port of Seattle can be profitable, but we need to understand the contract requirements first. So we only have 1 hour, so we can get started. We're just going to dive right in. So what is insurance? Insurance is where you're transferring one risk to another entity. So you're transferring your contracting operations to an insurance company to pay out should there be a loss with the risk of the work you're doing. The insured, so you pay the insurance company a set premium to provide coverage for said risk. And then the terms of the coverage are outlined in a contract, which is also known as your insurance policy. And this is also why the parties that you work with want to ensure that you're properly insured, because they're looking to protect themselves. And that's why we're going through the project manual today, because you want to look at this as what the port has in place to ensure these parties are protected, including yourself. So what we're going to do is you have bid solicitations. These solicitations are 244 pages. It's overwhelming for the information that you're looking for and focusing on, especially when you're looking at all the encompassing components of that particular job. So what I want to recommend is how I look through these contracts. Contracts are take a lot to review, and as an agent, you want to be thorough, but I'm busy. So I'm going to show you really quick what I do with these when I pull up this. So like I said, this is 244 pages. So if you're ready to bid, everything looks good, like, let's just look at the insurance requirements really quick. What if it's requiring a $10 million umbrella? I don't have that. How much does it cost? So what you just do is you Control F And in the upper right box here is find. So I just type in insurance.
Hey, Christina,
Yeah.
we're not seeing that on the screen.
Okay, it says I'm sharing. Okay, well, we'll just skip that. Thank you for telling me.
Yeah.
With this, when you type in insurance for the, let me just pull up my other screen here. There we go. So when you're pulling up the insurance requirements that are, just picture a huge long contract that's 244 pages. And you're going to get many insurance results. So the results are going to be under workers' compensation and a bunch of other things that will just seem confusing, because then your focus is going to be, what do I focus on here? And so there is usually a section that will show indemnification and contractor liability. And it's in those sections where you're going to find the coverages required and the limits. So what I've done is I've taken screenshots and I've put them on the slides for this class, so you'll directly see those requirements, and then I'll explain what each one of those means. So I was, with pulling that up, just going to show you the pages that those were. And then on the next screen, I just want to show you, if you're ever intimidated and do not feel comfortable reviewing insurance requirements, your insurance agent should and will do this for you. So what we have here is just simply attach the manual for the project, send your agent an email and say, hey, I'm bidding a new job. What am I missing here? Do I meet the requirements, or what else is needed? Can you let me know? Understanding the basics, though, of these contracts is very important for you as a contractor, because you're going to see these requirements repeat themselves time and time again. And sometimes when it comes to a bid deadline, you don't have the time to wait for your agent to review that. If you can just peruse the requirements really quick and get your bid packet out, that can be really beneficial to you. So insurance requirements, everything that's going to be in a blue box is what I've pulled from that project manual. So it says the contractor shall procure and maintain insurance in the following minimum form and limits: commercial general liability insurance on ISO form CG 00011001 or equivalent. For third-party property damage, bodily injury, personal and advertising injury, and medical payments, with not less than $2 million per occurrence. So as much as this seems like you just already want to glaze over and ignore what I'm saying, this is a very important part of what you're going to be reading in every single contract review. So the ISO is the Insurance Services Office. And what that's doing is that's just going to be the overall policy form. So when you think about this, think of just your overall policy documents and what that means. But what we're looking for coverage for third-party property damage, bodily injury, and personal and advertising injury is commercial general liability. So this is designed to protect your business for when you cause or are accused of causing bodily injury or property damage to another party. And then next, which is very important here, is the requirement is $2 million per occurrence. If anything, take that away from that section. So again, these are more wordy, but I want you to understand which each of these means and how important that they are, because I think that when people are looking at per occurrence or aggregate, it can be confusing and just kind of waste time. So hopefully by knowing these, it will save you some time. So per occurrence is the maximum amount the insurer will pay for all claims from a single occurrence. So if someone trips and falls and sues you, the $1 million limit is typically going to be the per occurrence. The aggregate is going to be the maximum they'll pay in a specified period. So usually that is 1 year is the typical policy term. So you want to think, okay, this is the amount that we'll pay. Aggregate limits are typically always double the per occurrence. So on your policy, you're usually going to see 1 million per occurrence, 2 million aggregate, or 2 million per occurrence, 4 million aggregate. Premises rented to you. This is a coverage that's automatically included in the insurance agreements within commercial general liability. Many contractors are like, when do I ever need this or use it? Can I remove this and have money back? No, just keep it on there. You don't need it, but maybe you somehow will, and it's on your policy. Medical expense limit. This was listed in the insurance requirements. So these are low limits. These are often 5,000, 10,000, or 15,000. And so what this is this kind of keeps the claim separate from your bucket. So, you have your per occurrence of 1 million, but your medical expense will be 5,000. So maybe someone sprains their ankle on a job site and wants you to pay their medical bills. You can file a claim under the medical expense limit, and that will cover those without digging into the overall bucket of your per occurrence to save that for when you really need it. So the insurance requirements are saying that the general aggregate limit shall be no less than 2 million per year. But they've already said in the other requirements that it's 2 million per occurrence. So just know that your aggregate, you can't do a 2 million per occurrence, 2 million aggregate, but we'll just keep these in mind as we're reviewing here. And within these requirements, it's saying that insurance shall cover liability arising from premises operations, independent contractors, products completed operations, personal and advertising injury, and liability under an insured contract. So I took this snippet from your project manual that lists the insurance requirements to illustrate that products and completed operations are required as a coverage, and so is personal and advertising injury. Products and completed operations is very important to have as a contractor. And I also pointed this out because for personal and advertising injury, some clients are like, I need a personal and advertising injury policy. How much is this going to cost? It seems daunting, but this is really also a coverage that's included in your commercial general liability coverage. So personal and advertising injury is something as a contractor that you're not going to consider as much as an important coverage to protect your business, but this is already included in your general liability coverage and required by contracts. So you want to just think of personal injury as being not bodily injuries. So things like libel, slander, infringing on a copyright, again, not as applicable to you, but it's nice to have, especially with this day and age. And then advertising injury, you can assume what that means is basically any TV ads or any other type of marketing campaigns that could be negative about another party. Products and completed operations. So I've gotten quotes for contractors and been like, hey, dear carrier, I don't see products and completed operations coverage on here. They're like, yeah, we don't want to offer it to them. So my question is, why would you offer that quote? So as a contractor, you have your ongoing operations, you have your risk that's occurring during your project. Well, once your project is completed, that's usually when things go wrong, is after the fact. So your products and completed operations aggregate limit is very important to have on your policy. And that is usually double what your per occurrence is. So you usually see this listed as 2 million. Insurance requirements. More boxes of these requirements. So I'm not doing these in order in how they're listed on the project manual. What I'm doing is so many of them are redundant and repetitive that I tried to pair ones that kind of mean the same thing that we could pair up so we can talk about them more efficiently. So the first requirement here is the contractor shall submit to the port a certificate of insurance and all additional insured endorsements were specified below, and any waiver of subrogation in primary and non-contributory endorsements. And then the next box is contractors shall provide evidence of insurance, including certificate of insurance, endorsements, and waivers where required annually up until the contract is closed out or on a more frequent basis if requested by the port. So what the top box is saying is that in order to bid this job, you must provide a certificate of insurance outlining the required endorsements, including additional insured, waiver of subrogation, and primary and non-contributory endorsements. The second box is saying, once you have these requirements met, you need to maintain them. So the port can say, hey, Christina, you're this contractor for this project. Can you just shoot me over your updated certificate? And then by maintaining the life of the contract, here it says until the contract is closed. So some of this can be confusing. And so further on in the requirements, it talks about the life of the contract being 1 year after the job is done. So 1 year after the job is done, the port can go in and ask you for updated certificates of insurance. So just make sure you maintain and keep your coverage in place. Insurance requirements. I'm going to talk about explaining the certificates of insurance and that in slides to follow. So don't worry, I'm not skipping that over. And so this, to me, this is like the meat and potatoes of what you're looking for when you're reviewing a project manual. So if the policy contains an annual general aggregate, this limit shall be no less than $2 million per year. So we've already looked at that when we talked about liability. Then it goes on to say the contractor's insurance shall be primary and non-contributory with respect to any insurance the port carries and applies separate to each insured. The port shall be named as an additional insured for all work arising out of contractor's work, including ongoing and completed operations using ISO endorsement form CG 2026 or an equivalent endorsement approved by the port. And then they're saying you need to provide additional insured, primary, non-contributory, and waiver of subrogation. Again, this is kind of redundant of what we've talked about, but as you can see, you can already hear the same terms used over and over again in these contracts, and that's what makes it so much more efficient for you to review them and understand rather than wait for someone else. So what we've heard over and over again when we've read those requirements on the past few slides is certificate of insurance, additional insured and endorsement, waiver of subrogation, and primary non-contributory. So what we have here is our certificate of insurance. So the certificate of insurance is a legal document. This is your proof of insurance. This has some things that I want to point out, and hopefully you can see the whole slide. So in the upper right corner, there's a date on the certificate of insurance. So regardless of your renewal date, if the Port of Seattle is asking you for an updated certificate of insurance, I recommend having your agent produce an updated certificate, and the port will know if that's updated based on the date in the upper right corner. So you just don't want to resend them what you sent them 6 months ago. And then right here on the certificate of insurance, it lists who the insurance companies are. So they have insurer A, B, C, and then the corresponding letter is put to the side so you know who the carrier is for that particular coverage. Now we have different blocks of coverage. We have our commercial general liability, automobile liability, umbrella liability, workers' compensation, and then this box is more of a free-for-all. I can put whatever I need in there. Sometimes this is blank, or sometimes the contract can require other coverages and we can list them within that box. So if we go back up to the commercial general liability, what I would like to illustrate here is all the coverages that I have just talked about in the previous slide are listed within this box. So the top one, we have each occurrence, damage to rented premises, medical expenses, personal and advertising injury, general aggregate, products and completed operations. So all those things you're proving that you have and they meet the contractual requirements because they're going to be on your certificate of insurance. Same with automobile. The rest of the coverages listed here, we are going to discuss further on in this class, but just for the sake of the visual, we're saying that you have $1 million in automobile liability. You have excess liability coverage. You have workers' compensation, but workers' compensation, we're only putting that you have employer's liability on the certificate. We cannot provide proof, and we'll discuss later why, but just know that you have to provide separate workers' compensation proof from the state of Washington and not your agent. Now, when they're talking about you must name us additional insured, so this is where in this box below is where include, the Port of Seattle is additional insured, coverage is primary non-contributory, forms attached. In this box, we list the Port of Seattle as the certificate holder. I have some clients that are really great that they will even review the certificates before sending. Because what is so important is that these have to be accurate. If these are not, they'll be rejected. And when certificates are rejected, you don't get paid. So that's what you have to remember here. If you're not in compliance with any of this, even if you've completed the contract and you're waiting for a huge $80,000 payment, this can be delayed a long time if your certificate of insurance isn't properly done. Within this certificate of insurance, we provide a copy of that, and then we have documents that we attach to the certificate. Those documents are the endorsements that are required, which are additional insured and waiver of subrogation and primary and non-contributory. Before we get to discussing those fun endorsements, there are some things in the contract that talk about the certificate of insurance that I'll quickly discuss. So certificate of insurance shall list each deductible or retention more than $25,000 for each line of required insurance coverage. So it's rare that you have any deductible for your liability coverage, so you don't really need to worry about that. The only time I think within your coverage that you're gonna probably have a higher deductible is something like your umbrella or excess liability, but just now list it, that's all they want. And then in this box below it, this is talking about you are responsible for all deductibles or self-insured retentions. So no matter what the scenario is, the Port of Seattle is making it clear that they are not going to pay your deductible. Whether someone that's an additional insured on your policy or someone else is filing a claim on your policy where something needs to be paid out, you're paying that deductible. Now, there's two different terms used within this requirement. The deductible is the amount of money you pay for a loss, and a self-insured retention is a dollar amount specified in a liability insurance policy that must be paid by the insured before the insurance policy will respond to a loss. So the best way that I would think about this is your vehicle has $5,000 in damage. Your vehicle's repaired. You go to pick it up. Okay, so to pick it up, you pay your $500 deductible to the shop, and then your insurance company will pay the $4,500 balance, because that is how that works. With a self-insured retention, this is more with liability policies. So if you do have like an excess liability, it will say self-insured retention, and they're usually higher. Oftentimes with some of these policies, you are paying out the amount until it reaches your deductible, or until it reaches the limit, and then they will kick in providing coverage such as like legal fees. Maybe you have to pay, your self-insured retention is $10,000. Once you pay the first $10,000, then your insurance will kick in. But oftentimes when talking to clients, we'll just use these terms interchangeably to reduce confusion. So an endorsement, I've used the word endorsement several times in this presentation so far. And really what this is this is any change that you're making to an insurance policy. So it can be, some people will call it a rider, some people will use them to add coverage, delete coverage, or exclude insurance coverage. So one of the enhancements that you can add to a policy via an endorsement is a blanket additional insured endorsement. So this is an endorsement that automatically extends coverage to any party to which the named insured is contractually required to provide coverage. So this is simple. It's great. You have a blanket insured on a policy. You get your certificates from your agent. They put your blanket additional insured. You're good to go. You're just not wasting any time and getting jobs, getting paid. You're compliant. But when you have a contract with an entity like the Port of Seattle, they do not accept blanket additional insured endorsements. They are not compliant with this contract. So you just need to remember that, because what I often see is customers will want me to just send their blanket additional insured endorsement, regardless of what the contract says. They send that to that entity that they're working with. They finish the job. And then 6 months later, they're calling back upset because the job won't pay them because they're not in compliant with the contract and no one within that team reviewed it before the job had started. And I just don't want you put in that position. It's very frustrating. It really impacts your cash flow. And so I just recommend trying to be compliant, within reason. If you ever want to negotiate someone accepting a blanket additional insured form, what I recommend is that you send it and ask for approval. Don't just try to sneak it through. It doesn't work. So here I have a visual of just an example of a blanket additional insured endorsement to show it doesn't show any entity scheduled on it. It just starts with the verbiage and then it's automatically included. So scheduled endorsements. So here's a requirement within the project manual. The port carries and applies separate to each insured. The port shall be named as an additional insured for all work arising out of contractor's work, including ongoing and completed operations using ISO endorsement form CG 2026-1185 or an equivalent endorsement approved by the port. So scheduled endorsements mean that instead of it just being the blanket language, it will specifically list the Port of Seattle on that endorsement. There are two different endorsements required to be compliant. There is one endorsement for your ongoing operations. There is another endorsement for completed operations. Sometimes people will say, well, hey, these cost to add to my policy. I want to just add the one for ongoing operations. Then when the job's done, I'll remove ongoing and add completed operations. I like that way of thinking, but that does not work. You have to issue these endorsements together. They're like a married couple that can never be divorced, and they have to stay on the policy throughout the term of the contract. The important verbiage to note here is also arising out of. You're going to see some endorsement language and some contracts decline your endorsements because they don't have arising out of language. So just be careful. And this is where you want to work with your agent. I have suggestions on what endorsements from each carrier comply, but although these are ISO form, Liberty Mutual has different policy form numbers for the endorsements that comply with this. Hanover, CNA, so each company could have a little different endorsement numbers that are compliant with CG 2026. So I didn't want to provide any confusion or anyone going and asking for the wrong endorsement because they don't have that particular carrier. So this is something that you definitely want to work with your insurance carrier on. Say, hey, I need endorsements compliant with CG 2026-1185. And that's exactly what you need to say when you're asking, and then you can go from there. So when you're scheduling endorsements on your policy, they add premium. So this is one of the profitability points I want to drive home in our class today, because these endorsements can range anywhere from $250 to $500. Well, when you're bidding the job, what are you putting in for your profitability? For your overhead here after costs and paying subcontractors? What if you plan that your profitability is $1,500? Well, if you have to maintain these endorsements for 3 years, that directly takes away your profitability. So with this, you have to maintain the endorsements during the job and then the life of the contract, which is a year after the job is complete. So what you want to do is make sure you're aware of what those costs are and then add that to whatever your profitability is. And that way it's not cutting into any of that. I get calls from clients doing this retroactively frequently, and they get very frustrated because they're losing money to maintain these endorsements. And to add the endorsements to your policy, allow plenty of time to do this because it can take sometimes a little bit longer, especially if an insurance company is behind, which many are these days. So you're going to include the effective date, a job site address, a description of the work, the contract amount, the job length, and then the specific language within that contract. So what they're requiring is always going to be into your contract, or I would ask questions from the entity that you're working with. And you can always get quotes from your agent for what this would cost as you're planning through a project, instead of just automatically adding and being like, oh, this is, $280 per endorsement. We're looking at $560 a year to add this. So just do what makes sense for you, and just know those will add premium to your policy. Waiver of subrogation in primary and non-contributory. I think that I have said those almost more than people have talked about Taylor Swift's dating life today. So I think that now we can talk about what they mean. These can be confusing when you're first thinking about these, and you may not care what they mean, but they're in every contract. So you should at least understand the overall concept of these endorsements. A waiver of subrogation is also known as a waiver of transfer of rights of recovery against others to us. So this is a contractual provision whereby an insured waives the right of their insurance carrier to seek redress or seek compensation for losses from a negligent third party. So what you're going to see here is your insurance pays out a loss. Your insurance company can't be like, you know what, we think that was really like the GC's fault, the general contractor, or perhaps even the Port of Seattle. Now that we've paid out this loss, we're going to go after the Port of Seattle or that general contractor. So by having waiver of subrogation in the contract, the Port of Seattle is protecting themselves from this type of action. And then as a contractor, if you ever have subcontractors, you're going to include this in your contract with your subcontractors. So you can see the chain of events of everybody really protecting themselves. Primary and non-contributory. This is a term also used in insurance requirements to stipulate the order in which multiple policies triggered by the same loss are to respond. So you have to think, when you're on these job sites and there's multiple contractors, who's responsible for that loss? And sometimes it can be confusing, but perhaps it's very clear, because let's say it's like with glass and glazing and you're the only glass contractor on site, that the loss will initially fall on you. And so this is where your liability coverage is primary and non-contributory. So what this means is your policy will pay first, and you're also not going to see contribution from other policies for that claim to be primary. So it's not like they're going to partner up. Usually your policy would pay the most of the loss, and then sometimes there may be other companies involved, but usually there's not going to be others. And so what this does is, this is also the Port of Seattle's way of protecting themselves to say, our policy isn't going to kick in for this type of loss. Yours is primary and yours is going to pay. And again, this is an endorsement that when you're hiring subcontractors, you'll also have in that contract. So understanding these and including these is very important, because we want to protect you. And by understanding these, you can see how much this can provide a huge difference in what could happen. Perhaps you have a subcontractor pay out and something, but you don't have a waiver of subrogation, then their insurance company can come after you and your insurance. And we don't want you to have claims. So there's an additional section within the project manual that talks about waiver of subrogation. So again, just driving home the importance of this and understanding how important it is within the contracts. And this gets more specific. So without affecting any other rights or remedies, contractor hereby waives its rights it may have against the port, its officers, agents, and employees, whether in contract or in tort, on account of any loss or damage occasioned to contractor arising out of incident to the perils required to be insured against within the contract. So this goes on with some more specific things, but again, you can't have them go after the other party. So now that we've gone over the certificates of insurance, additional insured, and what liability is, does anybody have any questions at this point?
There was one question in the chat. I'm going to stop recording for just a sec. Oh, okay.
I realized I had it, Kara. I'm sorry. I was looking on my own, what I was following with her, and I do have the general contractor.
Oh, you answered your own question?
I did.
Okay, okay.
So she was following through with the paper, and I was like, I followed mine, and I was like, oh, I do have it.
Perfect.
Yeah, any other questions? If you do, you can put them in the chat or ask. We have about a couple of minutes before Christina continues with her presentation.
This is Jeff Hollingsworth from the Port of Seattle and Risk Management, and I don't know where's the raise the hand button. I'm not familiar with the Zoom so much.
I'm
Okay.
sorry.
I had a comment, but I was also curious. Where is
Go ahead,
the
Jeff.
where do you raise your hand? I guess.
Okay, down below there's a bar. It says reactions on the bar.
Okay.
And then if you do that, you should see the little, and you
Okay.
scroll onto that, you see the raise the hand there. If you have questions while Christina is presenting, you can just put that into the chat and, during.
Okay. Well, so now that was a great overview of all the different documents and whatnot. The one thing too that's important is, along with the insurance requirements, there's the rest of the contract, and there's a connection between what's the indemnification statement and then what we're asking for in terms of to be an additional insured or assured. And all of our contracts are going to have a statement in there that are going to have, it's going to state something like, you agree to hold the port harmless, of the port, its officers, commissioners, employees, hold harmless against alleged this or that claims for injuries or property damage, that type of thing. And that's, these additional insured endorsements, they hinge on some type of a written agreement between, the port and its vendors. And that's an important clause in there because for certain types of contracts, we can, we're only going to be liable to the extent that we're liable, and we can't ask for more than that if it regards construction work, engineering, design, survey services, that type of thing. So a lot of times, I always recommend that when we have a procurement, that the agent or broker get a copy of not just the insurance requirements, but of the whole thing, including the indemnification, so that they can understand as well as the insurance company, what that connection is and what our expectation is to be indemnified.
Yeah, absolutely. And I think a good example of that is when I've talked about, when these particular contractors are thinking about hiring subcontractors and how that chain of event goes, the same goes up. Is how, the port has requirements that they can't work with people who don't have these insurance limits and additional insured forms. And it kind of all just goes down for the chain of events. And as far as the indemnification, absolutely, your agent should be reviewing all those. I think just fitting all this content in 1 hour, it really drives us home to focus on just the insurance portion.
Yep. So yeah, no, it's been great. I just wanted to kind of don't forget about the indemnification clause.
Yeah, absolutely. That's perfect. And initially I was pulling up a lot of that to show the indemnification, but my screen sharing wasn't cooperating. Any other questions or anything else I can provide? I will have one at the end as well. I just thought since we went over kind of the main portions of the insurance, that's would be a good stopping point. Okay.
We did one question, Christina, and then maybe after that we'll keep moving forward. The question is, when ordering a certificate of insurance, what information should a consultant provide their insurance agent / provider? A copy of the agreement and what bullets?
Yeah, absolutely. So I think sometimes when a client is doing consulting, for example, they'll say, hey, I'm doing consulting for this. So sometimes I'll ask the client, who are you consulting for? What are you doing it for? To make sure we have kind of the proper chain. And then I'll ask for a copy of the agreement, any insurance requirements that we should be aware of, because sometimes those are addendums that get cut off on those. Then I'll ask for who the certificate holder should be, so the name and address. And then usually we'll just put whoever that certificate holder is, like, hey, Port of Seattle is additional insured on policy. And then we'll provide a blanket additional insured endorsement or whatever requirements are there. So really, to start, I would say your agreement would be a great start, and then just make sure you have the address for the certificate holder. Perfect. Anything else?
I think we're good to go.
Yes. Okay, so contractor liability insurance. So prior to notice to proceed, the contractor at contractor's own expense shall satisfy the insurance required in this section. All insurance is to be kept in force for the life of this contract until work is completed. So this is one thing that I definitely have touched on before. But one thing to note is try to not do things retroactively. It is very important for everybody that you have your insurance requirements met before the project begins. Oftentimes they won't let you start unless you have those met, which could delay a huge timeline that impacts many other people, and you don't want to be that person. This is talking about at your own expense, you shall satisfy the insurance required in this section. So you can't send the Port of Seattle a bill for any added premium of the insurance being added within the particular requirements. So just again, when you're doing your bid, this is where you want to say, okay, here's my cost of insurance. Let's make sure I'm making this profitable for me, because I can't go back and do a work order with the port and say, hey, my endorsements were $580. Can we do a work change order in my contract for you to pay that? So just know that that's not going to happen. The life of the contract, from my experience, many contracts that we're seeing with many general contractors that are large, they're requiring 36 months or 3 years for you to maintain that coverage on your policy. So that's one of the first things I try to look for. Once I find the limits and many of the other requirements, say, okay, what's the life of this contract? And then what happens is, as the agent, is I will not remove those endorsements that we've added until the life of the contract is over. And I have ways of checking that with you, the client, just to make sure everybody's in compliance. But luckily, I feel like the Port of Seattle is really reasonable in this. It's just 1 year after the work is complete. So once your job is complete, I would set a calendar reminder for 1 year. And then after the 1 year, give your agent a call to remove it, because you'll save money, you'll still have met the requirements, and just make sure you provide that contract so they can really check that it's been a year. And then just make sure you're maintaining your insurance during this time. You don't want to cancel or remove things prematurely. You could be in breach of your contract. So the required insurance shall cover all contractors' operations of whatever nature connected in any way with this contract, including any operations under subcontract. Your subcontractor has to carry, the same limits of liability. So again, I think what this requirement is saying is make sure your insurance is written for the operations that you're doing. We don't want to have someone rated as a handyman doing roofing. We don't want someone who's rated as a roofer doing glass and glazing operations. So if you're ever unsure, you can have that conversation and they should be able to tell you why and how your policy is rated. And I would say oftentimes policies don't have a cookie cutter rating for all operations. So a lot of times there'll be notes or an explanation of how or why your policy is rated the way it is. What we want to make sure is that it is rated properly, so you have coverage should you have a loss. Because let's say there is a glass loss at the Port of Seattle and they think you're doing residential roofing, there could be no coverage, which is problematic, and which is why the port has included this statement within their requirements. Subcontractors, don't work with them unless they have insurance. I don't care if it's your friend or someone who's been a contractor for 30 years and just wants to self-insure. Don't, because if they don't have insurance, all of their risk falls on you. and the insurance must be equal or higher than your limits. So just remember, this bid is 2 million per occurrence. So you want to make sure that your subcontractor has 2 million per occurrence.
So I had a comment on that. Jeff Hollingsworth here. So we've taken a look at that pretty carefully over the past couple of years, and we're looking at what the work is, the duration, where it's going to be located at, and what we're doing in the commercial general liability and for errors and omissions, professional liability. We are putting ranges in there based on the overall contract value in terms of percentage that a sub is doing, so that we're trying to avoid the situation that on a blanket basis, the subs have to meet exactly the same requirements of the prime. So you take a $10 million contract, let's say for a variety of services. So 50% of the 10 million, if you have contractors that are doing less than 50% of the work, meaning like 5 million to 3 million, we will reduce. We're requiring 5 millions per occurrence, and in the aggregate for the prime who's got the 10 million, and you're at below 50%, let's say 2.5 million to, I don't know, 1 million, we're going to lower that requirement from, let's say, the 5 million down to 2.5. And then if you're under 1 million, a lot of times, if a sub's going to be doing 1 million or less, we're usually between 1 million per occurrence and 2 in the aggregate, or 1 million and 1 million. So that's something that we're doing. It's been pretty, we've gotten pretty good feedback on that.
That's great. And, I think Jeff brings up a great point, is things sometimes don't make sense with what's in the requirements, and you can easily work, and I have a slide on this, and negotiating your contracts. And when you're working with subcontractors, use common sense. If they're doing such a small part, don't make them have, a $10 million umbrella to work with you. We'll use some common sense here, and within reason. And I think even entities like Port of Seattle, or like even Skanska or Selin, some of those huge contractors that have large requirements, I see them make concessions on that all the time that are within reason.
Yeah, that's what we're trying to do that. And then also for whether it's a purchased good, or it's a service agreement, or if it's a construction contract, if it's a project that's being solicited, I mean, any of the bidders, they can raise their hand and ask a question. I mean, they could ask a question on the limit, coverage. I mean, and you'd be surprised sometimes, and that question that they pose then gets reposted with the question and the answers that we would get from the risk management side. And I mean, if you think that there's an error or questioning, is there room for a sub that's going to be only on the job, for a week doing $50,000 of work. If we get those questions, we'll answer them, and we may make a revision while it's still in the solicitation phase.
And so you want to obtain a certificate of insurance from all the subcontractors that you work with and have them naming you as additional insured. Because we only have an hour, I'm not going to talk about audits, but as a contractor, you're usually going to be audited after the end of every policy term. And when you're audited, they'll ask what your subcontractor costs are, and you have to provide a certificate of insurance from every subcontractor that you worked with. And if their limits are lower, it becomes an issue. Or if you don't have that certificate, they're going to charge you that premium, and you're going to have to pay more. So get the certificates, keep them on file, and keep them on file for 6 years. It's the magic number, is 6 years, but you want to make sure you get the renewal certificate and have someone. As smaller contractors, you're not going to have a staff member to every year follow up, but try to do some sort of follow up where you're asking for their updated coverage through the life of the contract. So once that life of the contract is up, a year and a half from now, you don't have to do that. Just keep it on file. Insurance shall be procured from primary and excess insurance carriers, whether admitted or on surplus lines basis, to have an AM Best rating of no less than A- FFC 6 or higher. So what this is talking about is the financial rating of your insurance company. This is something that I could tell you I used to just skim over and not care about when reviewing client contracts. But with current inflation and what's going on with insurance companies and the insurance markets. They're paying way more out than what they're collecting in premium. Things aren't the best. So what we want to do is make sure that we understand these, because these are impacting us all more than ever. So they talk about an admitted carrier. So an admitted carrier is an insurance carrier that is approved through the state's insurance department and subject to regulation by the state. And they also get their guarantee fund. So should you work with an insurance company that suddenly just tanks, they're financially can't pay for any losses, what they do is, if it's admitted, there's a guarantee fund. And I think for commercial general liability in Washington, it's like 500,000. So should you have a loss, the state could potentially kick in and provide some coverage. I haven't seen this before, but definitely something that is there. And you're going to see your quotes that you're getting on your policies and coverage that you have. Oftentimes will list like non-admitted next to your carrier's name. Now, if you have a non-admitted policy, it doesn't mean that you've done anything wrong. It typically means that there wasn't an admitted carrier available to offer coverage for your operations. So general contractors, roofers, type of masonry contractors, most of those, I can't get an admitted carrier. Sometimes I can. So they're with a non-admitted carrier. This is also referred to surplus lines, E&S, or excess and surplus. These aren't regulated by the state's Department of Insurance. There's no guarantee fund, but these do have more flexibility with coverage, offered products, and pricing. So these policies have taxes and fees. Admitted policies don't. But sometimes the flexibility of the non-admitted is really nice, especially to cover risks that don't have admitted carrier options. Surplus lines. So surplus lines can be admitted or non-admitted, but this is where we have to go through a broker to access carriers like underwriters at Lloyd's and other companies like that. That can be confusing because you may get a quote that says Brown and Writing at the top, but then the carrier is underwriters at Lloyd's. Just know that oftentimes, because of how things work and licensing, we have to go through those brokers to access those markets. And with the financial rating, we recently had an insurance company that we wrote a lot of contractors with. It was called Hallmark, and it went from an A- to a C. So you could be in compliance with this contractor here with Hallmark as of January. And then as February, we're urgently rewriting all clients that we have with Hallmark because their financial rating was so low. Regardless of contract requirements, we do not write with any carrier that has a low financial rating. So if you're ever curious or want to double check, AM Best is one of the companies where you can look up the rating of that particular insurance company. The Office of the Insurance Commissioner also has a link where you can look up how does my insurance company rate. So these are links, but really these do require a logon. So again, default to your insurance agent and ask, and they should have this information readily available for you. So more insurance requirements. Cancellation and non-renewal. Insurance is to remain current throughout the term of the contract. I think I've made it clear how long the contract is and that you must maintain your coverage during this time. But you're going to have make sure that the Port of Seattle is notified should your policy ever cancel or non-renew, and you'll get the notices from your agents when that happens. But you need to replace coverage if you're still within the life of this contract, because you'll be in breach of your contract, and that is not a good thing. So usually, depending if it's non-payment or for an underwriting reason, usually it's a 10 or 30-day timeline here. The contractor may meet required insurance limits for commercial general liability and auto liability insurance through a combination of primary and umbrella or excess insurance. Excess and coverage insurance must include the specific components of underlying required coverage identified. And so what this is important to understand is sometimes we'll get brand new customers calling like, hey, I've never had insurance. I need an umbrella policy. And it's like, okay, let's take a step back. What this is doing is there always has to be an underlying policy, and the umbrella is extending those limits. So most policies have a $1 million per occurrence limit, 2 million aggregate. The Port of Seattle requires 2 million per occurrence. So what you're going to do here is say, hey, I have 1 million per occurrence, 2 million aggregate. Dear insurance agent, can I increase my coverage from 2 million, 4 million? What would the added premium be? This is a very simple transaction. You would pay the additional premium, which is usually lower than you'd think. You meet the requirements. But what if your insurance carrier doesn't offer the 2-4 limits? You would obtain an excess or umbrella policy to meet those requirements. I'm going to talk about that on the next slide. So what do you do if the contract requires higher limits? So, and you have to think about this more than just getting up to the 2 million per occurrence. You could have many different scenarios. A lot of contracts will require 5 million per occurrence. And you're like, how am I supposed to do that? So you keep your underlying policy of your 2 million in place, and then you would obtain a $4 million umbrella policy to meet that $5 million limit. So you just do a little math, you can get there. So an umbrella or excess policy is a separate policy. It's that extra layer of liability protection that covers costs that go beyond your liability coverage. So if you have 1 million per occurrence, you max out at that limit. So should you have a loss that's 1.25 million, well, you have a coverage of $1 million. But if you have an umbrella policy on top of that, then that's going to pick up whatever is needed up to the limits of that umbrella policy. So that's why many entities like the port or that the port work with are going to say, hey, we need you to have these limits. And then it's not an automatic form. What you're going to know is that an umbrella policy has to have the underlying policies scheduled on it to extend that coverage. So usually you'll always have your commercial general liability, but you need to make sure that you also have your auto coverage and stopgap coverage included on your umbrella. We'll go over these two coverages in a minute, but just know that it's not automatic. And it's kind of frustrating when you do have an umbrella with just your general liability, and then you're adding your auto. If you have a fleet that you're adding to there, obviously that's going to be a big increase in premium. And then obviously with my last statement, I mean, if you do have a fleet, you should have an umbrella policy because your exposure is big. So it's not a bad thing. It's good to have the higher limits, the better. Commercial auto. So this is going to be, and some of these requirements here are a little bit more advanced should you have some different exposures, but we're going to focus on for what your operations are. You should just be needing the 1 million per occurrence. So you should provide business auto for all owned, non-owned, hired, leased, borrowed, or rented vehicles in an amount no less than $1 million per occurrence. So this is for scheduled auto. So oftentimes, if you have an auto policy, you have your scheduled autos on the policy and you're good to go. You provide your 1 million per occurrence and that meets the requirements. And then if the Port of Seattle or any entity that you're working with requires an additional insured endorsement, I usually will just call the company that you're with, and it's easy to get that endorsement. That sometimes isn't something that your agent has on hand for your auto coverage. Now we have hired and non-owned auto. So in the previous slide, the insurance requirements list all owned, non-owned, hired, leased, borrowed, or rented. So this is for scheduled is always going to be owned, as I outlined below. Whereas hired and non-owned auto is for when you don't have owned vehicles. So you still have to have 1 million combined single limits. So instead of having split limits, like you're probably familiar with, like 25, 50, 10, this is 1 million combined single limits for all those usually split up just in one bucket. Hired auto and non-owned auto are typically added to your policy when you have employees. But let's say you're a one-man show and you don't have owned autos and a scheduled auto policy, you can still add this to your policy without employees to meet the contractual requirements. Hired auto is going to be when you lease, hire, rent, or borrow vehicles. Non-owned auto is what I think is the most important requirement here, because it's going to be when employees' vehicles are used for a business. And so your personal auto limits are primary here. So let's say you have an employee, they're driving, they get in a car accident, and they're driving from a job site to a job site. What they're going to do is their limits will be primary, but if those limits are exhausted, more coverage is needed. That's when litigation, questions are asked, what were you doing? Typically what happens is the business gets sued. So by this coverage being here, it provides additional protection for your business, for your employee, and so that this doesn't roll over to any issues with the company that you're working with. And on the certificate of insurance, it would still say the 1 million at the top. We just have different boxes checked on the side for what coverages you have. Stopgap. We've talked about this a few times, and this is where it's more confusing with the state of Washington. But I'm going to not fully read these because we're getting short on time. But Washington has a little bit different stopgap and workers' compensation requirements because they're monopolistic. So here, this is just talking about Washington stopgap requirements, the limits of 1 million, and that you have to comply with revised codes of Washington and some other acts down here. So stopgap. Workers' compensation is a no-fault statutory benefit prescribed by law where an employer has to provide, compensation or due to an injury or even death. So in Washington, I know nothing about this. Clients ask me questions, I tell them, call Illinois, call the state. I'm not allowed to handle workers' compensation in Washington state. I do have many other clients that have employees outside of Washington, and I write those workers' compensation policies. So what you do have from your insurance agents in Washington is stopgap coverage. So this is what we call employer's liability coverage. And this is basically funding, a whole kind of different section of the workers' compensation. And I think that to keep it simple, we're not going to delve too far into that. Just know that if you have a liability policy, make sure you have stopgap on that policy. So in their insurance requirements, they do have some of the RCWs and other things listed. So I didn't want to leave you empty-handed when you're reading those, like, oh my gosh, what are those? How do I know if I need to comply with those? So here are links where you can read them and decide. The highlighted one here is the one that's most specifically listed. The other ones are also mentioned, but just read through those and then you can decide what you'd like or need. Acronyms. Your insurance agent, people you're working with are going to start throwing these things out there, especially when I'm really busy and I say HNOA. So here's just a page on the acronyms for what you can at least feel like you can follow a conversation in insurance. Negotiate. So I think the biggest thing about contracts is I want to provide you with the tools to understand those coverages, needing those coverages, the importance, but I'm also not an attorney. So there's a lot of things. Contracts are written by attorneys. And so there's always going to be questions. Every contract is going to be different. But I think even when we're working with entities like Port of Seattle or large contractors, they typically want to work with small contractors to help them win these contracts. So how can you do that? And I think now that you can kind of see what the port requires, this is also pretty standard what they're requiring, and it's nothing too over the top. So I think when you're looking at these things, negotiate within reason. So, is the limit unreasonable? If it's not, just email them, call them. Hey, could we do this? This limit makes sense for me because of the revenue in my business, or this is what I feel like my exposure is at your job site. Or does adding a coverage completely not make sense for your company? Negotiate so that they can remove that coverage. And if it really does make sense, they'll typically remove it and agree. So just don't be afraid to ask questions. I think it's super important, whether it's of your agent, what it means on a contract, or the party that you're working with. Okay. Try to speed through that so we can get the last hour for Cara and get a break here. So if you have additional questions, if I can clarify anything that I said or help you with anything, here's my contact information, and thank you for your time today.
Thank you so much, Christina. A wealth of information on insurance. It's amazing. So we really appreciate it. We do have limited time. So if you want to type your questions in the chat, I think we'll go that route today and take about a 5-minute break so that we can take a little bit of break and then head into our discussion on bonding, if that's okay. So it's 4:10 right now. If everyone can come back at 4:15, that would be great. So welcome everybody back to session 4 of the Advanced PortGen 2023. We're going to listen now and learn from Cara Skinner about bonding. She has some great information to share, so I'll toss it over to you.
Thank you so much. I'm going to probably talk fast because I want to get as much information as I can into this short time, but I want to make sure that everybody comes away today with something that they didn't know. So feel free to interrupt. I don't know if that messes you up, Cara, but I don't mind being interrupted as long as I'm giving you something that you need. My name's Cara Skinner. I'm a 3rd-generation surety bonder. Have a lot of resources available because you're not going to probably learn everything in this. We're looking at maybe half hour, 45 minutes here. I also wrote the Little Black Bond book. That is, you can get the hard soft cover on Amazon, but you can also download that for free at littleblackbondbook.com, littleblackbondbook.com, and I'll give you that resource at the end as well. So what the heck is surety bonding? It is not insurance. When I was little, my father used to say it is the opposite of insurance. So everything you just learned, just turn it around, and now we're into surety. So bonding is assurance. Traditionally, it's a guarantee that somebody's going to do something and perform. It is a credit relationship, and it's going to feel very credit relationship, like you're dealing with a bank if you're dealing with a surety company or your surety bond professional. Since bonding and insurance do go together, like Christina and I, we kind of go together. I thought it would be nice to see the difference. And this was one of the questions I think that was asked before the presentation. So for surety bonds, usually it is a minimum of a 3-party agreement. We're going to go over those 3 parties. For insurance, it is usually 2 parties, right? When you buy insurance for your car, you're going to have the insurance, you, the insured, and the insurance company. Those are your 2 parties. For surety, this is the biggest difference. For surety, the surety bond does not protect you, the one who purchases the bond. The bond protects a 3rd party, our obligee, and we'll go into who that is. So for insurance, you're getting the protection. For surety, some 3rd parties getting the protection. The surety bond is usually, I'm going to say usually because nothing in life, in surety, in business is absolute or always, right? So usually the surety bond is project specific. And in the case of the surety bonds we're going to talk about today, whereas insurance, Christina was saying, it's usually 1 year, right? So you pay for it and you remember to continue to renew it. Whereas the surety bond is attached to a contract and doesn't usually renew. For surety bonds, the claim is initiated by the owner obligee, not by you, the principal, the contractor. Whereas for insurance, it usually is you, the contractor. When we underwrite surety bonds, the idea is that we underwrite to no losses. In other words, we don't want to issue a bond for someone we think is going to have a claim. Whereas for insurance, some losses, nobody wants a loss, but losses are anticipated. The idea of insurance is to share those losses, right? Because no presentation is complete without a Venn diagram. These are our parties to the surety bond. We have the principal, the obligee, and the surety company. Those are things that you can see in big writing there. The little writing, which you may not be able to see depending on the size of your screen, in the middle there is the bond. So all three parties are part of the bond. There is a contract between two of the parties. There's an indemnity agreement and then a guarantee between the others. I'm going to go into what some of that stuff is, but let's start with the three parties to the contract, the surety bond contract. So the principal. Who is the principal? The principal is usually you, the contractor. So during my presentation, I'm going to be saying you a lot, assuming that you are the contractor. The principal is the entity, the contractor, that is ultimately responsible for fulfilling the obligation. You are, as a contractor, in this scenario, you are the first in line to make sure that obligation is complete. Our obligee, this is a word that you don't hear in a lot of other industries. The obligee is the public agency or the general contractor. The obligee is the bond holder. So if we think about the bond like we do a financial product, we're going to write out the bond like you might write out a check, and we write it out to the public agency. So in this case, we're going to make it out to the Port of Seattle. They are the bond holder. They are the entity that is requiring the bond, in this case, contractually. And they are the beneficiary of the bond. So you as a contractor, the principal, you are never the beneficiary of your bond. And that is a big difference between surety and insurance. The beneficiary is your obligee, in this case, the Port of Seattle. So our third party is the surety company. The surety company is the one that is standing with the principal to guarantee the principal, the contractor, you are going to perform your contract. Usually it's an insurance company. There are some situations where it's not an insurance company, but we're not going to go into that because I don't recommend that. Sometimes I like to look at the surety company as a cosigner. Sometimes we call the surety company the money, right? So we've got the contractor partnering up with the obligee, the port, right? There's a contract there, and the port wants to make sure that the contractor fulfills their obligation. So the surety comes in and cosigns with money, a piece of paper saying, yes, we are going to guarantee that the principal is going to fulfill their obligation. Am I talking fast enough? Okay. So usually surety bonds come into play with public works contracts. We're going to go over three different kinds of bonds. There are, and I know you're going to all think I'm joking, there are millions of different kinds of bonds. Every city, every county, every port, every town, every state, the federal government, all have their own bond forms and guarantees that they're looking for. We're going to go over three main ones that a lot of obligees are looking for. The first one is the bid bond, and it's kind of what it sounds like. This is the bond that you usually will need when you're bidding a project. Usually it's some small percentage because the bid bond is kind of like a deposit. It's a deposit to, and in this case, we're going to say Port of Seattle, even though a bid bond wasn't required. We'll go into that in a little bit. But it's a deposit to the obligee to say, here's 5 or 10% of the contract to say, hey, I'm already pre-qualified. I can get performance and payment bonds, and I will provide them and enter into a contract if I'm the low successful bidder. So that's what the bid bond is. The next, if you are the low successful bidder and you are awarded the contract, this is when performance and payment bonds come into play, and exactly what it sounds like. The performance bond guarantees, it's attached to the contract and guarantees everything in that contract that the contractor, the principal, is going to perform that contract. Part of the bond, or sometimes a separate piece of paper, is the payment bond, and that guarantees that you, the contractor, are going to pay your sub-suppliers and material people. The reason for this is because most of the time you can't lien public works jobs. So this payment bond protects the sub-suppliers and material people, making sure that they get paid, because on a residential job, they may be able to lien the project, whereas for public works, you traditionally can't do that. All right, I think this is important this was nice for me to see where the bonds connect. So in this case, the very top there is our obligee. Our obligee is the Port of Seattle. Port of Seattle asks the contractor for a bond. So there's a bond where the obligee and the general contractor, principal and obligee, have a bond, right? And the surety company, of course. But let's say that this is a much larger job and our general contractor is hiring a bunch of subcontractors. You see those down there. They are also principals on bonds. So in this case, so those three little bonds down below, the principal is the subcontractor, and our general contractor, who was the principal on this bond, is now an obligee. Have I lost everybody? Are we good? Okay. Underwriting. This, I would love to do like a whole 10 or 15 minutes on where the word underwriting came from, because the history of it is really interesting. But I'm going to just tell you what it is. Most people have heard of it either in insurance or if you've applied for a loan at the bank, specifically something larger than a credit card. Basically, underwriting means there are people, underwriters, that are going to verify information in order to approve something, right? Either a loan at the bank or an insurance policy or a surety bond. For surety, we have two main categories that we're going to underwrite. The one is the contractor, you, the principal. We're going to underwrite the principal to see if you qualify for surety bonding. I'm going to go into a little bit of that in just a minute. And then once the surety company has qualified you as a contractor, then we look at the actual project and the obligation. So we were underwriting two separate things. So you could be fine where you're approved for bonding, let's say up to $1 million, but you come to the surety company with some wackadoo contract, not of course this Port of Seattle one, and we may not be able to bond that specific obligation contract. So two separate kinds of underwriting here. So first we're going to talk about underwriting you, the contractor. And a big part of underwriting is only 3 C's. I think I heard Kara say somebody has 7 C's. I don't even know how I would keep track of 7 C's. 3 is my max. So the 3 C's of surety are character. Character is really hard because it makes it sound like we're like, well, if we like you, you get a bond. It doesn't really work like that. If you're honest and if you're open, if you fill out the application correctly with correct, honest information, that's one way to judge character. But really, character oftentimes comes from capacity and capital. So capacity is, are you able to do the job? Do you have the ability to do the job? Do you have the experience to do the job? Have you done a job this size before? Have you done a job for this owner before? That's the kind of things we're looking for in capacity. The surety company will look at experience, and we have made oftentimes phone calls to prior owners to see how the contractor is doing. Did they do a good job? That kind of thing. Were they on time? And really the most important question I ask when doing references is, how did the contractor handle problems? Because I don't have to tell you that there is not one contract out there that didn't have a problem on it. They all have problems. And it's how you deal with those problems. Capital, when you're in the underwriting process, it probably is going to feel like 100% of it is capital, because this is where we can get most of our paper. This is where we can get most of our data and information. But I want you to know that really it is 1/3 of the underwriting. So the capital portion is the financial and the credit. Do you have the funds to start a job? So for $1 million contract, you, the contractor, you do not have to have $1 million, right? You do need enough to start the job. You do need enough working capital to probably at least pay for 30 days of labor, material, supplies, and so forth. So you don't need $1 million for $1 million job, but you do have to have enough working capital to start the job, to mow, and so forth. So that's what we're looking for when it comes to capital. Underwriting documents, I think everybody was sent, and I do have it, and we can go through it, but I don't want to spend too much time on this. But the underwriting documents that are typically going to be required is an application. We need to know your history, who you are, what you do, the areas that you work in, your largest jobs. All of that's going to be really, really important. Company financial statements and personal financial statements. I can do a whole 4-hour class on just that. So I can answer tons of questions, but I don't want to take up your time on financial statements, even though I really enjoy financial statement underwriting. A couple other things in the underwriting documents are a bank line or bank statements. What I want to say for this, though, is sometimes getting a bank line of credit as a contractor might not be as easy as just going into the bank and saying that. But if you're doing all of this work to apply for a surety bond, the banker is going to need a lot of the same stuff. They're going to need an app. They're going to need financial statements. So if you're already collecting all this stuff, I suggest developing a relationship with your banker and seeing if you can get a working capital bank line of credit. And if you say, I don't need it, I always work, I've got enough cash, that's awesome. This is insurance. This is just in case. Your bank line of credit is just in case. And if you wait until you need a bank line of credit, your financial statements might not look as strong as they do when you're just starting a job. So I would suggest getting a relationship with a banker who understands construction and applying for a bank line of credit, and get as much as you can and have that in your back pocket. So if for some reason you get paid late, the paperwork gets in late to the owner and you don't get paid for another 30 days, you have some insurance and you have a little bit of working capital in the bank to take care of that. Okay. Some other things that are going to be especially important if you're new in business is a resume and a business plan. And I bet you Kara can help point you in the direction to help you with those things if you don't already have it. I would suggest, even if you're not new in business, to keep an up-to-date resume and an up-to-date business plan. So that is, all of that is underwriting you, the contractor, the construction firm, as well as you personally. And then the last thing that we're going to underwrite now, right? We're going to underwrite the actual job. So we're going to start looking at the job. This is the bond request form. This is the last page of that starter kit that everybody, I'm sure, took a look at and read through word for word. This is that last page of that. There are 5 sections on there. So the top section is the principal contractor. We talk about the bid bond, the final bond, performance of payment, project, and then the obligee. I want to point out I'm using some words interchangeably, like final bond and performance of payment bond. Those we use interchangeably. So the bid bond is your first bond for a particular job. The final bond is the performance of payment bond. I had a contractor, I was using the word final bond on the phone, and he said, oh my God, this is the final bond you're ever going to write for me? So I thought I need to address that terminology, and I'm going to try to explain the terminology as I go. So I did snippets of the sections of our bond request, so you could see a little bit about how to fill it in and some of the things that are going to be important. This top part is you, the contractor. My dog's name is Sunny, so I made this Sunny Construction. This should be the easy part for you, filling in your name and address and so forth. I'm going to talk about the bid bond section, even though the port for this particular job did not require a bid bond. And here's why. The bid bond, remember I said the bid bond is like a deposit to say, hey, I am pre-qualified. If I'm the low successful bidder, I will provide performance and payment bonds and enter into a contract. Your surety company needs to know if you're going to bid a job that is going to eventually need performance and payment bonds. So that way, when you are the low successful bidder, you can go back to your surety professional and say, hey, I'm low, here's the award, I need final bonds now. If you hadn't told the surety company about this, there may be a problem in there in the initial underwriting of you as the contractor. We need to get financial statements updated, or there might be something in the specifications that make it so that your surety company does not want to bond this particular job. So even if a bid bond is not required, but performance and payment bonds are required, just let your surety company know you're bidding it. Send them the invitation, the bid package. Let us take a quick look at it. Make sure that if you are the low successful bidder, that we are able to provide those final bonds for you. And you didn't go through all of this work and effort just to find out you can't get those performance and payment bonds. So we're going to look in the bid package and in the invitation. And Christina mentioned this already, control to search, control F. If you haven't done this before, I'm control Fing on, oh, that sounds bad, on everything. So hopefully it's a Word doc or a PDF that is searchable. And a lot of times they are, and you can control F to find different things in the job, for the job, pardon me. So this was one of the things, and I can't remember what I control F'd, but it was probably bid bond. And this is where I found in the specifications that no bid bond is required for this contract. But I did find this interesting. So it says that the performance and payment bonds are required. And number 1 here says failure to provide timely performance and payment bonds will result in non-award, obviously, and forfeiture of any bid bond or security. So in this case, you didn't provide it, but if you had, let's say you didn't provide a bid bond, but the option was to provide cash, because some obligees will take cash as a deposit for a bid bond. So let's say you did post some cash. Let's say you posted 10, 15, 20,000 in cash. And now your surety company doesn't know anything about this. If you hadn't gotten pre-approval, there's a good chance, and it says it right there, you could forfeit that security. So let your surety professional know what you're bidding, especially if there's even a hint that surety bonds could be required. So this is the final bond section of that bond request form. I think this is pretty easy to figure out. What we did was we did control F on the award letter and the contract. And I think, I can't remember who was talking about it earlier, if it was Christina or Jeff, looking through the paperwork in the contract, you can ask questions. Sometimes there are, like, so at the bid process section, you can ask questions of the owner. There might be, though, and maybe Jeff can clarify this, some owners have a specific time when you're allowed to ask questions, and then there's usually a cutoff, and then you can't ask questions after that. So as soon as you get your invitation or solicitation, your bid documents, start looking at them right away. If you see anything in there that has questions, if you've given it to your surety bond professional and they have questions, ask them as soon as possible, because there could be a time limit on when you're allowed to ask questions or not ask questions. Okay, so back up here. In order to find some of this information, I'm looking through the award letter and the contract. This is just a snippet of the award letter. And this is where it actually mentions specifically that you have to have bonds. It gives you a little bit more information on what the bonds need to say. We're going to go into that a little bit. I'm still talking really fast, right? I'm doing okay? Is everybody still following? Okay. So the next section on our bond request are bond forms, and the Port made this really easy. They have their own bond forms, and I took up 4 slides for bond forms because this is a surety presentation. Nice that the Port kind of filled it out for us. This performance bond, 2 pages, and the payment bond, labor and material payment bond, will be filled out and completed by your surety bond professional. You, as a contractor, are not filling this out and typing on it. You will eventually need to sign it, but you will not be typing it out. So give that to your surety bond professional. They will fill that out for you. On here, I'm going to go through the next slides pretty quickly because I'm going to reiterate some of what Christina said. And that is, if you look on here, it says important. Surety companies executing bonds must have an AM Best rating of A- FSC of 6 or higher. Does that sound familiar? Remember, we were looking at, for insurance, there was the same kind of request. So this is a picture of logging into AM Best, and I put a little login up there because you have to have a login. This is kind of behind the scenes stuff that Christina and I do when we're looking at stuff. So we're kind of giving you an idea of what's happening behind the scenes here. We're going to look this up for you. You don't necessarily need to, but it's really interesting information. So what I thought I would do is I looked up Liberty Mutual, because if you haven't seen the commercials, everybody knows who Liberty Mutual is, right? Because of those ridiculous commercials. So I thought I would look up Liberty Mutual, and they're a good sized company. So here's Liberty Mutual. So we're trying to find out if they are what they're rated. So basically those screens that I was doing, I was just scrolling down. These are snippets. You'll see that Liberty Bibberty is an A, which is excellent, which is good. And then remember it said FSC. FSC is the financial size category. And if we go back to grade school, you remember in Roman numerals, so X and V is a 15, right? And this says it has to be a 6. So we're good. But again, your surety bond professional will be looking that up. Something that is unique to surety and not insurance, at least maybe Christina can tell me for sure. It says, and our surety company has to appear on the Treasury Department's most current Circular 570. What we call this is the Treasury listing. So the federal government has a list of certified surety companies. They have certified every surety company that can write a federal bond. And they've listed them all here. They update it once a year, and they get numbers, underwriting limitations on here. So this, you don't need a login for. I'll get you the links to this towards the end, but here's your list of certified companies. I looked up Liberty Bibberty, and here is all their information. So they are on the T listing, right? So we're good to go on that. All right. Are we still all good? I'm moving on a little bit. We're going to talk about the contract. Okay. So some of the contract details that we want to pay attention to, we meaning me, the surety bond professional, but you too as the contractor. What is your timeline? What is the schedule in the contract? Workmanship warranty, sometimes called a maintenance period. And I found this really interesting. I actually learned quite a bit, Christina, on the insurance. Thank you very much. It sounds like you have to keep your insurance policy in force for that extra year, which I'm assuming is the workmanship warranty year. By statute, I think most contracts in the state of Washington have a 1-year workmanship warranty. So you as the contractor are warranting the work that you did, the labor that you did on that job. So we want to pay attention to that, because sometimes there can be some wacky maintenance periods in there. Liquidated damages is another one. And you know how I'm finding all of this information? Control F in those contracts and in the invitation or solicitation and so forth. So liquidated damages are penalties for late completion. Typically, you will see liquidated damages a dollar amount per day. This particular contract for the port is, they're not going to have liquidated damages because the schedule is kind of an on-call schedule. So it's not a fixed firm price contract where if you don't finish on this day, then you're going to get penalized for late completion, $100 a day, $200 a day, $500 a day. Sometimes it can be really crazy, like $50,000 a day. And this is why we want to pay attention to that, because you don't want to sign a contract with crazy liquidated damages that you didn't know were in the contract. Payment terms, retainage. This is something you want to pay attention to, so you know when you're going to get paid. You can plan for cash flow. And then the bond forms. And again, this is something that I just Control F and I look for bond forms. This is the workmanship warranty section that I found. And again, Control F, and I think I went warranty, and I think this is how I found that. But this says that you've got a 1-year workmanship warranty. The reason that you need to know that is because you need to know how long you're going to be warranting this, because if it was 3 years, the port could call you in 3 years after you've done the job and say, hey, this thing that you put in, you didn't put in right, and you need to go fix it. And if you're not prepared for that, it could be, you could have some problems. Retainage is another one. You want to, this is another cash flow, something to keep in mind. If there is retainage, and it looks like on this one there is, again, Control F, and I found retainage is 5%. That means that of every draw that you get from the port, they're going to hold back 5%. So we're filled out this is the project section. We're still filling out our bond request, you guys. So this is the project name. A lot of this I was able to just pull off of the award letter or doing my Control F to find all of that stuff in there. The obligee section, this is the part that a lot of people actually make a mistake on, which I find really interesting. And it's because it says job owner, obligee, general contractor. And if you are, depending on where you are in that project hierarchy, remember, are you the general contractor or are you the owner? So wherever you are in the Venn diagram, if you are the Port of Seattle in this particular case, you are the owner obligee. If the general contractor, let's say Sunny Construction, they were going to hire a subcontractor to do like another, not in this case, but like $1 million worth of work. And Sunny Contractor, the GC, wants to make sure that their subcontractors are going to perform and pay sub-suppliers and material people. That's when another bond would come in, and the owner would be Sunny Construction. Have I lost anybody yet? Are we all still here? Okay. This is what a completed bond request form would look like. I'm not going to go into all that stuff. And again, please interrupt me, tell me to slow down, ask me questions. I'm here for you as a resource. This is what everybody wants to know. How much does it cost, right? Because you want to put this in the line items when you're bidding your job. So for sure, that's another reason at the bidding, even if a bid bond is not required, but performance and payment bonds are required, please contact your surety bond professional. You want to get that premium in your line items so that it's not coming out of your profit and overhead. Bid bonds are typically free. Every once in a while, we'll see a surety company charge $100 or something for bid bonds, but typically bid bonds are free. Performance and bank payment bonds, 3% is probably the high end, but if you're a new emerging contractor, you're probably going to be in the 2 or 3% range. I would start at 3%. Some of the things to keep in mind, and I was thinking about this when Christina was talking, and that is if the contract price increases or the time increases. So for insurance, you have to pay attention to that early on, and you do for surety bonds as well. But let's say there is an actual change, a real change, not a, this is a 3-year contract potentially, right? So we're prepared for that. We're going to give you the information to put in the premium for that length of job. But let's say something happens and prices just go crazy. The port has a bunch of money and they're like, let's increase this job by another $350,000. When you do a change order that changes the amount of the contract, put in your bond premium, because just like in insurance, the surety company is going to go back and audit that job, and there will be premium due at the end. And same with time. If the time of the contract runs long, like an extra year or two, there will be a surcharge. If it's a couple of months, couple of weeks here or there, it's not a big deal. But if there is a long time, there could be a surcharge. And I want to, again, make sure that that is not coming out of your profit and overhead. There should be a line item in there for that. Okay. Types of contracts. Usually what we see in surety is lump sum or fixed firm price contracts. And that is pretty much what it says. You bid an exact amount, exact for construction, an exact amount, and that's the bid, and that's what your contract is for. And really, I think that is probably one of the most risky, and what partially makes construction so risky is you have to be really, really careful with that estimating. If you make a mistake in your math, if you make a mistake in forgetting some items, and you are the low successful bidder, 1, you could lose your bid deposit, or 2, you could lose even more if you decide to enter into that contract and you forgot a bunch of stuff. So that is a lump sum fixed firm price contract. Time and material, I think, is the best for contractors. They're able to say, here's my time, here's my material, and they get paid. But you don't see that a whole lot in public works. Another kind of contract is IDIQ, the indefinite quantity or definite delivery, indefinite quantity contracts. A lot of times this term, I think, is more federal, and we'll see those kinds of contracts in federal work, but you'll also see like job order contracts, which is kind of similar to an indefinite quantity kind of situation where you know that the owner, we're going to keep going on with Port of Seattle. You know that the Port of Seattle, the owner has some money and they have all these things that they want done, but it's not a fixed firm price for the actual contract. You might have a fixed price for different items. And then when the port needs you to do something like this glass contract, then you come in and you do that portion of the glass that needs to be fixed or repaired or whatever. Good. Okay, here's some references. You don't need to write this down. I can get this to you, but that's where the US Treasury is. That's where AM Best is. Some more information on surety. You can go to Integrity Surety, littleblackbondbook.com. That's where you can download your free book. If you want to know about me, I'm at thebonder.com, and there's a story about where the term the bonder came from, because it's not a term that anybody else uses. It's something that my father and I made up. So there's a little write-up on me, my father, and my grandfather there at the Bonder. And if you have a bunch of hours, free time, you can go to Learn NASBP, SFAA, NASBP, Educator Bonding. This is a class that is actually, we've done a really good job on this. There are little videos and little quizzes. NASBP is the National Association of Surety Bond Producers. SFAA is Surety and Fidelity Association of America. So we came together and made this education thing, but it's pretty lengthy, but it's free. So consider. And I talked fast enough.
You talked so fast.
I hope I didn't lose anybody.
Well, thank you for providing your information. So if people do have follow-up questions, Cara is available to answer those. Make sure you reach out to her. And these are the next, we just wanted to make sure that if you weren't aware that there are some more PortGen sessions coming up. Week 5 is next Tuesday on financial considerations, and then there's a resource fair on October 17th. That one is in person, and it should be a great event. So I encourage you, if you're not already signed up, to register for both of those. The resource fair will be a great chance to also do some networking. So
and I plan to be at that. So if you have some questions or you want to talk one-on-one, I'm happy to set up some time with you if you decide to go to that.
Great. Thank you, Cara. Jeff,
And
I noticed.
we're going to stop recording and then ask for questions, because that way people can ask questions and know they're not being recorded.
Oh, yes. Thank you for that reminder. I'll do that right now.